Revelations from my man cave. My name's Jeff Banks, I'm from Property Portfolio Solutions, and today I want to talk to you about the consequences of this deal. Yes, we've been talking about this deal. We've been talking about all sorts of things regarding this deal, including the equity uplift, the property profit, the return on investment, leveraging and all that sort of stuff. But let's look at the consequence of this deal. Now remember we said in earlier videos that this client sold this particular property. Okay, I'm an investor, therefore I'm looking for some sort of return. And as Benjamin Franklin said, there are two things that are certain in life: death and taxes. So let's have a look at the tax position here. Right. One would think that this might very well be a capital gains tax transaction, and that the profit would normally have the capital gains tax reduction of 50%, and we would pay tax on $125,000. Now, if that meant that I was on the top marginal rate, that $125,000 would be taxed at 47%. All well and good. The only problem is there's a nasty little word inside the Tax Act called intention. And you need to be really careful when it comes to this here. Now, on the face of it, this client appears to have been someone looking to buy, construct and rent the true nature of what one might term property investment. But at the end of the construction period, we sold it. Does that show the intention of having a commercial type ideal on what we did here? Or does that just show it's a realisation of an asset that we did because at the time here we thought it was the peak of the market, so we shelled it? When it comes to taxation, we need to be able to prove to the taxman that what we suggested we were doing is what is actually happening. Otherwise, they'll take a low-hanging fruit approach, and rather than allow us the 50% general exemption for capital gains tax, they'll tax us on the whole $250,000. Think about that. That's the difference between the tax on $125,000 versus the tax on $250,000. All about this word here, intention. Now, all our evidence that we were talking about that we can show the tax department on behalf of the client is that this client's intention was always to get a rental return. We would argue that it took 18 months, so it's outside the 12 months purview of the capital gains tax legislation. So the capital gains tax should apply on the basis that we realise this asset because we believed that the market at the time was at the top of its particular cycle, and that to hold it any longer would not get us the value increases that we potentially were looking at going forward. Tax in Australia is difficult. You need to be talking to your accountant about those sorts of things to make sure that you don't get caught with a bill on $125,000 more in this particular case than what you should have. My name's Jeff Banks, I'm from Property Portfolio Solutions, where your legacy is our inspiration.